Are you aware that all expert investors are always ready for a market crash? Not to sound pessimistic, but being ready for the market crash tends to help you prepare for the unforeseen future. Usually the crash occurs once in a decade, but it's impossible to predict when the next one will happen. So it's always best to prepare yourself in case of a crash so you can protect your investments. People tend to lose their homes, properties, and money when such events happen. Buy with adequate preparation, and you might not just get too affected. In today's video, I'll guide you on steps to avoid this market fall and prepare yourself for the future so you can have a huge potential in case of new opportunities. Make sure you stick around till the end to find out the number one step. Remember to like this video and subscribe to the channel. Number 7. Diversify. For a long time in a bullish market, a portfolio could be imbalanced and overly concentrated in certain outperformance holdings. In other words, some investments may have grown rapidly, resulting in a dangerously high percentage of your portfolio. For example, if you bought Tesla stock years ago when it was 5% of your portfolio and it outperformed your other investments, those Tesla stocks may now represent 50% of your portfolio. That portfolio structure is very risky and doesn't prepare you for the future, bearing in mind that the biggest gainers are also the biggest losers when the market fails. If you're overly invested in specific industries, sectors, or firms, now is the best time to assess your holdings and to ensure that you're well balanced. Would you be satisfied with your current holdings if the market were to crash tomorrow? Number 6. Paydown margin. Margin refers to the amount of equity an investor has in their brokerage account. Purchasing securities on margin entails borrowing money from a broker. For example, suppose an investor buys $100,000 in shares with cash and then another $50,000 on margin. The investor will pay a 5 percentage point interest payment and hopes to earn more than that. The difficulty here is that if the stock price falls, they are still obliged to repay the loan, and they may be forced to sell the stock at a low price to pay back their loan. This is a high-risk strategy that few investors would consider. Many successful investors advise against using margin at all costs. But just a few months ago, margin debt reached an all-time high. Margin debt looks great when you're making an excellent return on a bull market and makes you forget how things can get ugly pretty fast. Number 5. Create multiple streams of income. Having multiple sources of income has always proved to be beneficial, but it's especially important during a market meltdown. The main reason for this is that when the economy is in shambles, expenditure and employment are lost. Having several income streams helps you to have various cash flow sources pouring in. This puts you in a better position to be prepared if one of the multiple sources of income fails, as it did for many people when they were laid off during the pandemic. Relying on one single income source from a job is very risky. Instead, aim to maintain various income streams, whether through company investments or other occupations. The added security will prepare you for the unexpected and can be utilized to invest or spend on recreation. Fortunately, there are numerous ways to earn extra cash so that you can have multiple incomes. Number 4. Don't obsess over the market. Worrying about what the market is going to do every day is not good for your mental health or your finances. Instead, concentrate on the bigger picture and what is likely to occur in the future. Things might be red this month, but will they still be red next year at this time? So far, the market has always regained its losses and continues to rise, rewarding those who haven't been alarmed by every minor fluctuation. If you're concerned about a market crash, it's probably best to keep investing regularly even if stocks reach an all-time high. According to Peter Lynch, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. At some point in the past, people have been concerned about a market crash and have halted their investments. In most of these times, they are always wrong for doing so. One way of making it in the stock market is by being patient and always keep investing. There is an opportunity for new traders and professionals alike to learn about the stock market and even set themselves up for trading. It's an opportunity you shouldn't miss. Just click on the link in the description below as fast as you can, because it's only open to the first 30 people, and you set yourself up to earn more in the stock market. Number 3. Understanding that decline is inevitable. Investing in the stock market with the intention of always making a profit and never losing money is unrealistic, and that mindset is setting you up for failure. After a decade of gains in the market, people assume that the stock market is a place where asset values only increase. In actuality, it's reasonable to anticipate a 20 to 30% drop in prices at any time. It might seem like a lot. Actually, it is. Consider how much money you've made and how much money you're likely to make if you invest for a long time. A modest drop from time to time isn't a big concern when you're doubling your portfolio worth every 7 years on average with an S&P 500 fund. How would you restructure your finances if the market dropped that much next week? As the saying goes, greed inevitably triumphs over fear and has been shown repeatedly in every market cycle. Number 2, pay off debt. It should come as no surprise that keeping debt levels low is important. The problem is that it's easy to become comfortable with your income and expenses to the point where you're not prepared for a financial crisis. After years of earning great money, the mortgage, car payment, and possibly a second mortgage in your second property seem little. If you can pay all those bills while still investing a little money, do you know that your expenses are reasonable only based on your current situation? Would you still have a lot of money if your income stops or you take a huge pay cut? Rich people flourish regardless of the economic cycle because they live far below their means and spend only a small portion of their income. This increased security means that they can continue as usual even if their income is reduced. By paying off additional debt, you will be able to live far below your means, just like the rich do. Number 1, save cash. The best method to be prepared for any situation is to build up cash reserves and have a fully funded emergency account. Always keep at least 3 to 6 months worth of living expenses in cash in case of an emergency. Depending on your strategy, you may decide to save even more money so that you can buy stocks when they are on sale. The disadvantage of keeping cash is that it may lose purchasing power due to inflation while sitting in a savings account, generating little to no interest. With today's inflation rate, your funds will only be worth around half of what they were 15 years ago. This can be annoying as the stock market rises month after month and our expenses also climb. Ask yourself, would you rather have 3 to 6 months of living expenses eroded due to inflation or risk losing your home because you can't pay the bills? Sometimes people get greedy and forget how much that savings would have helped them in the last recession. Stock market crashes don't happen every day, but as an investor, you should be prepared for them. Don't become greedy and short-sighted, forgetting that a significant downturn is possible. Instead, try to structure your finances as if the market were to crash tomorrow, keeping in mind the mistakes you've made in the past. As the saying goes, there's always a light at the end of the tunnel. Thankfully, crashes don't typically last that long, and the temporary fears and doubts you'll experience will be rewarded with profit. Let us know what you think about these ways to avoid a market crash in the comments section. Leave a big thumbs up on this video if it has been of help. And if you're new on our channel, subscribe and turn on your post notification. See you in the next video.